Right, we're now going to pass over, and Helen will go a bit more, not into fine detail, but she's just going to give you a bit of an oversight into what is this annual allowance and the lifetime allowance that you've heard of today, and why we sometimes need extra information from you or confirmation that the information we have had is correct, because it can actually incur a tax bill to people. Thank you, Helen.
You've heard this subject a couple of times now, so I hope I don't bore you. It's fairly new announcements, and all the pension funds still getting to understand the changes, and we are waiting for fine details from the government. So in preparation of this presentation, I thought I would practice it to my lovely dog Max, and this is what's happened. So hopefully you'll stay awake a bit longer than he did. Right, as you've been hearing, there are limits on the total amount of contributions you can make into your pension scheme and receive tax relief. And HMRC sets an allowance, and the two main ones are the annual allowance and the lifetime allowance. So what is the annual allowance? Well, it is a limit to the total amount of benefits you can build up across in one scheme year and receive tax relief. It applies to all pension schemes, not just per scheme. So if you're in two pension schemes, you have to look at it as a whole. The scheme year is known as the pension input period, which is usually referred to the PIP. And the current PIP for the LGPS is the 1st of April to the 31st of March. And to work out how much value the benefits have increased during the PIP, for defined benefit schemes like the LGPS, you need to work out what the benefits are at the beginning of the period, and work out what the benefits are at the end of the period, and then the difference in annual pension is multiplied by a factor of 16, plus any increase in the lump sum or any AVC contributions you paid during that period. And this is otherwise known as a pension growth. So as you've heard, the current limit is £40,000. So if the employee is over the amount, then the excess is taxable. So this is why it's very important for employers to send us a correct final pensionable pay and care pay at year end. If the pay is incorrect, then the benefits will be incorrect, and that could cause one of your employees to have to receive a tax charge in error, or not having a tax charge. If an employee correctly goes over the annual allowance, then there is opportunity for them to use any unused annual allowance from the previous 3 tax years to offset some of the excess. If there still is an excess, it is taxed at the employee's marginal tax rate. They also need to declare this on a self-assessment form, and if the tax charge is over £2,000, then they can use what we call the scheme pay option, which basically means the pension fund will pay the tax on behalf of the individual, and then will reduce their pension on retirement permanently. And the deduction is calculated by dividing the tax that we've paid over by a government's actuary department factor based on age, gender. So who can be affected? Mostly employees with a substantial pay or increase or bonus within that year. Bonuses and pay awards count in the year that they were paid, not for the period that they were due. Therefore, if you're planning to give one of your employees a bonus or a promotion, you may want to point this out to the employee that what it could impact them. So they can get in contact with us, and they could ask the questions, have they got any unused tax allowance? It shouldn't put employees off from promotion, but it's better than to be aware and understand the impacts. If an employer awards additional pension under Regulation 31, which Becky will be talking about later on, you are likely to increase the individual growth. So that's another you could be affected. Also, an employee with a large previous pension rights transfers in, or they transfer their service from a different LGPS fund, that can impact on their annual allowance. And therefore they need to be aware of those implications when making decisions. On the 8th of July, the Chancellor, George Osborne, presented his summer budget, which included significant pension taxation announcements. The key changes were the taking the reduction to the annual allowance for individuals earning over £110,000 from 2016-17, the alignment of the pension input period to the tax year from 2016-17, and the transitional arrangements for aligning pension input periods for 15-16 to protect any pre-budget pension savings. The taper reduction to the annual allowance, well, what is this? There are two new pay definitions that have been introduced into the pension tax environment, and these are called threshold income, which is the individual's taxable income for the year from all sources, less any pension contributions. Adjusted income is the individual's taxable income from all sources, but this is plus employee pension contributions, plus the value of their pension growth for that year. The government announced that they needed to bring in measures to limit the annual allowance for high earners to a minimum allowance of £10,000. This will be done by an introduction of a tapered annual allowance from April 2016, and it applies to employees' earnings above £110,000. So the annual allowance will be reduced by £1 for every £2 of adjusted income over £150,000. There will be a minimum annual allowance of £10,000. So this means individuals with an adjusted income exceeding £210,000 would have a personalised annual allowance of £10,000. Any pension input amount in excess will be, again, subject to the annual allowance charge. One difficulty in the new regime is that the annual allowance for the tax years depend on the individual's taxable income for that year. And as a result, some individuals will not know that until after the end of the tax year. So there are some actions employers can do. You can assess who in your workforce will be affected by this change and communicate the changes to employees so they can make informed decisions that maximise outcomes rather than just minimise tax. You can always signpost your employees to our website to find further information or contact our help desk. The alignment of pension input periods and transitional arrangements. Well, all pension schemes in the UK would have a 12-month PIP from the 6th of April to the 5th of April and tax years thereafter. This is the period that they will need to measure the pension input amount. Many pension schemes in the UK, like the LGPS, don't currently have a PIP ending on the 5th of April, and there is a need to transition into a new PIP this year. The transition is complicated. All current PIPs will end on the 8th of July, pre-budget, and a new one will run from the 9th of July to the 5th of April 2016. The transitional rules is to ensure individuals aren't penalised or open up tax holes in 2015-16. And achieving both of these objectives has required some very detailed legislation. What are these? Well, I will try to explain in simple terms how I understand how it would work. When I use the word pre-alignment, I mean a period from the 1st of April to the 8th of July. And when I use the word post-alignment, I mean the period from the 9th of July to the 5th of April 2016. Most individuals will have a transitional annual allowance of £80,000, which will only apply for 2015 and 16. However, it is subject to a maximum annual allowance of £40,000 for the period from the 9th of July to the 5th of April. To simplify the process for defined benefit schemes like the LGPS, the approach is likely to be that the 2015-16 will be notionally split into two mini tax years, and then the pension input amount will be based on one combined input periods and then apportioned to the pre and the post alignment tax years. The annual allowance for the pre-alignment tax year is the £80,000, and where this hasn't been used in full for that period, it will come forward onto the post-alignment tax year, but again capped at the £40,000 of any unused. Any remaining carry forward from the previous 3 years can be added onto this amount in the normal way. This means it could provide some individuals an opportunity to save more in the 2015-16 than they would have expected at the beginning of this tax year. What does this mean for employers? We don't know. It is something we are looking at from the start to understand all the implications of the alignment of pension input periods. Therefore, no decision has been taken at this time as to whether we'll need additional information from you at year end. We recognise that employers need to know the changes to year-end requirements as soon as possible, so you can need the software updated, and we will provide further guidance once we're in a position to do so. Right, I've come to the end of my annual allowance, and now I'll move on to the other main HMRC allowance, which is the lifetime allowance. What is the lifetime allowance? Well, you can save as much as you like towards your pension, but there is a limit on the amount of tax relief you can get. The lifetime allowance is an overall limit on the value of pension benefits you can build up across all pension arrangements without incurring any further tax charges. When your pension comes into payment, its capital value, which is calculated by multiplying your annual pension by 20 plus any lump sums. This then needs to be checked against what the lifetime allowance is at the time of your retirement. The current lifetime allowance, as you've been hearing, is 1.25 million. And if the lifetime allowance is exceeded, there is a tax charge. And the tax charge is 55% if the excess is taken as a lump sum, and 25% if it's taken as a pension. It was confirmed that the lifetime allowance, which Lord Osborne announced in March of his spring budget, would be reduced to 1 million, with effect from the 6th of April 2016. We have been waiting for details from the government on the two new transitional protection, called Fixed Protection 2016 and Individual Protection 2016. And those are for really protections for pension savings close to exceeding 1 million. It has been recently announced that the legislation for both these protections will be delivered in the Finance Act 2016. The time of this bill means that full details of the transitional protections will not be known until after the 5th of April 2016, when the reduction will have already come into effect. And these implications, especially for those who want to apply for the fixed protection, will be impacted. So we're going to assume it will be on the protection will be based on similar protections when the lifetime allowance reduced in 2012 and 2014, but we don't know this for sure until we receive the final details. If we are assuming, here is a summary of the protections. If a member applies for fixed protection 2016, they can maintain the lifetime allowance of 1.25 million. However, members generally have to opt out of the pension scheme so they don't accrue any further defined benefits. If they do accrue further defined benefits, they will lose the protection. This now means that a member who hasn't applied for fixed protection, which in previous protections you had to before the effective date, nor has the full details before their decision whether to opt out of the scheme or not in April 2016. If a member applies for individual protection 2016, they will have already needed to have a lifetime allowance of at least 1 million. They will then have a protected lifetime allowance at the value of what that is at the 5th of April 2016, up to the maximum of the 1.25 million. With this protection, you're able to continue further accrual in the pension scheme without losing protection. And again, the protection, if it has the same principles as individual protection 2014, then it can be applied to at a later date. I've gone to the end of my talk now, and I hope you haven't fallen asleep like my dog did. So thank you for listening, and does anybody have any questions?